I'm going to show you the real mechanism behind Strategy's decision to authorize a sale of up to 1.25 billion in Bitcoin. And the reason you should listen to me is I've been covering the corporate Bitcoin treasury thesis since it started, and I understand the leverage model well enough to explain why this specific moment, not the price drop itself, is what really matters. I'll deliver it by breaking down what mNAV is and why it just fell below 1 for the first time, what Strategy actually authorized versus what the headlines implied, and what this means for the corporate treasury thesis going forward. Welcome back to another video. On June 29th, Strategy, Michael Saylor's company, filed a 8K with the SEC announcing something called the Digital Credit Capital Framework. And buried inside that is a new Bitcoin monetization program authorizing the company to sell up to 1.25 billion worth of Bitcoin. Headlines exploded. Peter Schiff called Strategy now a Bitcoin seller. Arkham posted about it with dramatic imagery that spread across X in hours. And a lot of people jumped straight to the conclusion that Saylor is dumping his position, predictably. He's not. Strategy still holds all 847,363 Bitcoin. Not one coin has been sold under this new program. Yes, I know they just sold 32 Bitcoin several weeks ago, but this is separate from that. Something did break this week, and it's more important than a headline number. On June 27th, 2 days before this filing, Strategy's mNAV fell below 1 for the first time ever. If you don't know what that means yet, stick with me, because this is the real story, and almost nobody's explaining it clearly. So what is mNAV, and why did it just break? Let's start with the term everyone's throwing around without explaining. mNAV stands for market net asset value. It's the ratio of Strategy's enterprise value, meaning their market cap plus debt and preferred stock minus cash dividend by the value of the Bitcoin they hold. For years, the ratio traded well above 1. That means the market valued Strategy's stock at a premium to the actual Bitcoin sitting on their balance sheet. If they held $1 billion in Bitcoin, the market might value the company at $1.5 billion or $2 billion. Why would investors pay a premium for Bitcoin they could just buy directly? Because Strategy wasn't just a Bitcoin holding company, it was a Bitcoin acquisition engine. Investors were paying for the belief that Saylor would keep raising capital and buying more Bitcoin per share over time using leverage retail investors can't easily access themselves. And that's in addition to the fact, obviously, that people just buy the security, MSTR stock, for that leverage, hoping that they'll see gains that exceed that of Bitcoin. And here's how the flywheel works. Strategy stock trades at a premium to its Bitcoin holdings. That premium lets them issue new shares or preferred stock above the value of the Bitcoin backing them. They take that capital and buy more Bitcoin, which increases their holdings, which, as long as sentiment stays strong, keeps the premium intact, and they can just rinse and repeat. And this flywheel has worked incredibly well from 2020 through most of 2025. It's the entire reason Strategy went from a mid-cap software company to the largest corporate Bitcoin holder in the world. But on June 27th, that ratio fell below 1. For the first time, the market values Strategy at less than the Bitcoin actually holds. The premium is gone. And when that premium disappears, the flywheel stops turning. Issuing new equity or preferred stock to buy more Bitcoin no longer makes financial sense, because they'd be diluting shareholders to buy an asset the market says they're already overpaying for. And that's the actual headline this week, not the 1.25 billion authorization to sell. The mechanism that funded years of aggressive accumulation, however, has just seized up. So what Strategy actually announced? Let's get precise about what the Digital Credit Capital Framework actually contains. It has 5 parts. First, a board-approved USD reserve policy, currently funded at about $2.55 billion. That's meant to cover about 17 months of dividend and interest obligations. Second, there's an increase to the STRC preferred stock dividend rate up to 12% from 11.5%, which, by the way, that dividend doesn't matter if you still lose capital. Like, STRC has gone from $100 down to 75, 80. I haven't checked where it's trading at recently, but I think it's still below 90. Third, a $1 billion buyback program for their digital credit securities, which covers their preferred stock series. Fourth, a $1 billion buyback program for their Class A common stock, which kind of makes sense. And that's been a criticism of that people like Peter Schiff have levied is, hey, if they can do all this stuff, and then when mNAV falls below 1, they can, and their stock, their shares, things like STRC, falls below what its typical peg was at 100. Say it falls to 80, now they can buy back at that price. Anyway, it's actually, for once, it's actually kind of a valid criticism in my opinion. But the fifth thing is Bitcoin monetization program authorizing Bitcoin sales of up to 1.25 billion for those specific defined purposes. And that's not a mandate to sell, it's authorization, similar to a shelf registration. Strategy can act on it later if needed, but they're not obligated to. As of the filing, they'd paused new Bitcoin purchases for the week of June 22nd through the 28th, but their holdings, all nearly 850,000 coins, remain untouched for now. Why does that matter specifically? Strategy carries real financial obligations. Their preferred stock stack, which includes things like STRK, STRF, STRD, and STRC, have an annual dividend burden that exceeds 700 million combined. STRF alone compounds to an effective 18% rate if payments are missed. When Bitcoin was near 125,000 and mNAV was comfortably above 1, covering those obligations through fresh equity issuance was trivial. It was easy. At $59,000 Bitcoin and mNAV below 1, it's not trivial anymore. Issuing equity at a discount to their Bitcoin holdings would actively hurt existing shareholders. So this framework is strategy building optionality. If Bitcoin stays low and the capital markets stay unfriendly, they now have a legal pathway to sell a defined capped amount of Bitcoin to keep the lights on, so to speak, without missing a preferred dividend payment or triggering a credit event. If Bitcoin recovers and mNAV moves back above 1, that program will likely never be used. To put the ceiling in perspective, 1.25 billion is about 2.5% of their total Bitcoin position. At 59,000 per coin, that's roughly 21,000 Bitcoin. Interesting number there. Out of the almost 850,000. It's a real number, but it's not liquidation. This is obviously steps they're taking to avoid any potential liquidation. And I mean, it's a smart move overall, but it does look bad. I mean, let's just be honest here. A lot of things about strategy and Saylor have started to look bad recently, and it's not just because of the bear market. I mean, that's kind of what triggered it, but overall, it's not looking so good, we have to admit. So why this matters for the corporate treasury thesis. I want to zoom out here because it's not just about strategy. It's a stress test for the entire corporate Bitcoin treasury model that dozens of companies have copied ever since Saylor started it in 2020. The model that Saylor pioneered depends on a specific condition. The market has to be willing to pay a premium for shares of a company holding Bitcoin rather than just buying Bitcoin directly themselves. That premium is the fuel for the entire engine, or this flywheel. Without it, using leverage to accumulate more Bitcoin per share just doesn't work anymore. It becomes dilutive instead of accretive. Strategy is the largest, most established player in the space, and even they have now hit the point where that premium evaporated. And that's definitely a signal worth paying attention to if you're tracking the dozens of smaller companies that adopted the same playbook over the past 2 years, many of which have not done so well. Some of those companies never had strategy scale, credibility, or access to capital markets. If the flagship company's flywheel seized up at these prices, the smaller, more leveraged copycats are under even more pressure right now. That doesn't mean the whole corporate treasury thesis is dead necessarily. Companies like SpaceX hold Bitcoin without any of this leverage structure, buying with cash from operations, simply holding it on the balance sheet like any other reserve asset. That model doesn't depend on a stock premium at all, and it isn't exposed to this kind of stress. What this does mean is that leveraged premium-dependent version of the corporate treasury strategy, the version strategy built and everyone else copied, is being tested in real time by a prolonged bear market for the first time. We're about to find out which companies built something durable and which ones built something that only worked when Bitcoin was going up. And I'd like to add that, if strategy continues to do well and Bitcoin recovers, it could be a buying opportunity now that mNAV is below 1. But at the same time, this could lead to a total loss of confidence that just sort of destroys their model forever. So I don't know. We'll see. I don't think it's a sign that strategy is in imminent trouble. They still hold all those hundreds of thousands of Bitcoin, working their way toward 1 million Bitcoin, worth around 50 billion right now. Their cash reserves still cover well over a year of dividend obligations. The authorization is capped, defined, and optional. So they're managing risk proactively. They're not like backed into a corner on the verge of collapse, although it's being framed that way, of course. But I also don't think this is just no big deal. I mean, the mNAV compression is real. reflects a genuine shift in how the market's pricing corporate Bitcoin exposure. And Saylor built a model that worked exceptionally well in a rising market, and we're now watching what that model looks like under sustained pressure. If you're holding MSTR or any other leveraged Bitcoin treasury stocks, this is worth understanding on its own terms, separate from just watching the Bitcoin price. And if you're holding Bitcoin directly, none of this really matters. None of it changes the asset itself. I know people always say, well, Bitcoin strategy is going to be forced to dump all their Bitcoin, get liquidated, and that'll flush out the market and create a huge crash. Right now, that's not very likely. If Bitcoin fell to like 20,000 and stayed there for years, then that would be a real possibility. I don't see that happening though. So what this changes is which corporate wrappers around the asset are built to last through a full cycle, and which ones were only ever built for a bull market. Because Saylor started this in 2020 after the COVID crash, and it's more or less been up and to the right since then. I mean, there was the 2022 bear market, yes, and that was bad. But he didn't have nearly as much Bitcoin and wasn't using as much leverage back then. And he never had to do any of this stuff, never had to sell. He did sell a little in 2022, actually. That was the first time. But never had to create this kind of framework for potentially selling more because he didn't have the same dividend obligations with things like STRC and all the others and wasn't as levered up. So things are getting a little more complicated. Just to recap, Strategy's mNAV fell below 1 for the first time ever, breaking the premium that funded their entire accumulation flywheel. In response, they authorized, but didn't execute, the sale of up to $1.25 billion in Bitcoin to protect their balance sheet. It's a stress test for the leveraged corporate treasury model, not a liquidation event. If this helped you understand what actually happened this week, please hit like and subscribe. It's a great way to support the channel for free. Check out the Bitcoin blueprint if you want to learn Bitcoin the right way and quickly. There'll be a link in the description, and I'll see you in the next one.